I've been covering this space for years. We have watched enforcement actions. We've watched builders leave the country. We've watched projects burn, millions in legal fees, fighting a regulator in the United States that refused to write the rules down. In a nutshell, we've watched the cryptocurrency industry ask over and over again for one thing, and that is clarity, market clarity. On March 17th, yesterday, and I feel like I'd like this to be kind of the definitive deep dive into what we just witnessed yesterday, because I feel like it's probably one of, if not the most defining moment in the history of crypto. But yesterday, March 17th, 2026, we got it. The Securities and Exchange Commission and the Commodity Futures Trading Commission, or the SEC and the CFTC, issued a joint final rule. This is release 33 TAC 11412 that you'll see here in a second. And this rule does something that neither agency has done in the history of crypto. It drew the lines and it gave clarity. 16 assets were explicitly named and now officially classified not as securities, but as digital commodities under federal law. We're going to talk about what that means as well. And the chairman of the SEC, Paul Atkins, said this at the DC Blockchain Summit yesterday as well. Quote, "We're not the Securities and Everything Commission anymore." This is the video that I've been waiting to make for years in this space. This is the biggest regulatory document in the history of crypto, and today we're going through every single word of it. All right, so I'm going to pull this up here. There are two different kind of press releases that we put out yesterday, but stay with me on this, because if you watch one video, this is probably the video to watch. March 17th, 2026, and again, the Paul Atkins, "We are not the Securities and Everything Commission anymore," the decade of war. So I guess to understand why this document is historic, we really do need to understand what came before this document. Previously in crypto, the SEC engaged with crypto assets for most of the decade with regulation by enforcement, as maybe a light way of putting it. There was no tailored framework on crypto adoption, no clear taxonomy, no rule book, just enforcement actions filed against companies that had no guidance to follow. The Security and Exchange Commission, or SEC's, position was essentially figure it out, and if you figure it out wrong, we will sue you. And if you come to us for help, you're going to get a Wells notice, and we will sue you. Ripple knows what that looks like. Library certainly knows what that looks like, and others. But the SEC filed a suit against Ripple in December of 2020, arguing that XRP was an unregistered security. Ripple spent 4 years and hundreds of millions of dollars in legal fees fighting for that case. And I know that Ripple ends up being the butt of a bunch of jokes across crypto, and still seems to be battling for, I don't want to say legitimacy, but battling for credit where credit is due, I guess. But at the end of the day, I think we have to admit that Ripple took lots of blows for the crypto industry as a whole. While the XRP ecosystem, developers, partners, payment corridors, and financial institutions operated under like literally a legal cloud that the SEC had deliberately left in place. So in and of itself, it is amazing, regardless of what you think about XRP, that XRP maintained positioning with where it was at, that the developer community and the builders and that the retail community, institutional community, that everybody kept faith throughout a period of just frankly, like pure uncertainty. Coinbase also knows what it looks like. Kraken knows. Exchanges that were named in actions that delisted tokens under regulatory pressure, that watched institutional clients walk away because compliance departments could not get a straight answer from Washington. Solana knows. Sol was explicitly named in enforcement actions against major exchanges during the Gensler era. Solana has, whether you like it or not, been the fastest growing retail layer one in the world. And they also sat in regulatory purgatory while their retail ecosystem literally exploded. Developers kept building across crypto, though users kept onboarding, but the institutional capital that could have accelerated everything, and especially built up the United States, stayed on the sidelines. And from the Solana ecosystem specifically, obviously another ecosystem that had, for a time, a government flag on top of it. But here's the brutal irony that the SEC now acknowledges. That approach did not protect American investors. It protected, in reality, foreign competitors in an industry that we know is taking over the entire planet. Blockchain, distributed ledger, and cryptocurrency, as you probably have realized from watching this channel and some of the institutional interviews and everything else that we do here, is essentially an upgrade to the internet itself, whereas the internet upgraded everything and basically democratized our access to information. The blockchain and distributed ledger and crypto essentially democratize our access into value. So while U.S. projects burned capital on lawyers and international teams built without having to deal with that overhead, talent left the United States. Capital left the United States, and innovation happened in areas like Singapore, in areas like Dubai and Zug, because building in America meant building with like literally a target on your back. So on March 17th, this all changed. Now, in reality, if we go back a little bit further, the writing has kind of been on the wall that there has been a change probably for the past, let's say, 14 or 15 months, right? The new SEC under Project Crypto, which is an actual Project Crypto is what the SEC has kind of deemed as this like innovation arm. A joint SEC CFTC initiative was launched January 29th, 2026. So Project Crypto, and it set out to do what its predecessor like literally refused to do, which is draw clear-cut regulatory lines, distinguish securities from non-securities, and give the crypto industry the rule book that it never had. Release 3.3 TAC 11412. Let's go through it because this is probably the most important piece of documentation that we've gotten thus far, not for stablecoins, but for cryptocurrency native. So let's see this category taxonomy here. So the heart of this document is a 5-category taxonomy for all of crypto. You can go through here. You can find this as like literally it's on the SEC's website. Maybe here's the table of contents, crypto assets that are subject to investment contract, et cetera, et cetera. Anyways, I'm going to kind of leave us here on the homepage here. But the SEC is telling you for the first time ever exactly what bucket every asset in crypto falls into and exactly what the legal consequences are. Now, keep in mind, this is a joint guidance between the CFTC and SEC. So, and they're calling this kind of the final ruling for this is the interpretive guidance here. Here are the 5 categories. Category 1 is digital commodity. You can see these categories right here. Category 1 is digital commodities. Now, what this means is that these are crypto assets that are intrinsically linked to and derive their value from the programmatic operation of a functional, decentralized crypto system and from supply and demand dynamics, rather than from the expectation of profits from the essential managerial efforts of any person or company. In plain terms, if the crypto network runs itself and the token that powers that network, it is a commodity. Or in the token powers that network, it is a commodity. So if the crypto network in and of itself kind of runs itself and the token powers that network to run, it would represent a commodity, not a security. The CFTC jurisdiction will be in spot markets. The SEC is out of the picture for anything named a commodity. For those of you that are with us here in 10 minutes, here's the digital commodities that the SEC has now deemed. Bitcoin, we knew. All of the other ones, XRP, we knew, given the court case. Everything else is new here. Aptos, Avalanche, Bitcoin, as I mentioned, Bitcoin Cash, Cardano, Chainlink. Now, these are like the name. So literally BCH, ADA, BTC, Apt, AVAX, Link, Dogecoin or Doge, Ether or ETH, Hedera, which is actually Hbar, Litecoin or LTC, Polkadot or DOT, Shiba Inu, so SHIB, Solana, Sol, Stellar, XLM, Tezos, XTZ, XRP. And I believe if you look at it, Algorand and library, for example. Now there's a footnote. It flags you to footnote 51 here under the definition of digital commodities, because I saw a lot of people asking about this. You can see right here, footnote 51 at the tail end of this sentence. Footnote 51 saying that, for example, based on their characteristics, terms, and functions as the date of this release, Algorand and library credits are digital commodities because they are intrinsically linked to and derive their value from I'm not going to finish the footnote, from the programmatic operation of a crypto system that is functional, as well as supply and demand dynamics, rather than from the expectation of profits from the essential managerial efforts of others. So all of the assets that are up here, so Aptos below, obviously for this channel, we talk a lot about Hedera and Hbar. We talk a lot about Solana. We talk about Stellar when I find news that pops up about Stellar. Certainly Chainlink, XRP, obviously BTC, AVAX when I can. But I mean, this is absolutely huge. And then down below, you can see that library and Algorand also tied into that. So category 2 here is digital collectibles, NFTs, meme coins, in-game items, trading cards, digital art, anything designed to be collected or used for its cultural, artistic, entertainment, or social value. Value driven by supply, demand, and community, not by any managerial promise, are also being deemed not securities here. The document specifically calls out that a meme coin, which has been acquired for artistic, entertainment, social, and cultural purposes, does not become or constitute a security simply because its creator is active in the community or facilitates its growth. That is not what they consider essential managerial effort. Category 3. It might make sense for me to just maybe stay here. Go to genfinity.io, by the way, and you'll get maybe more of a high-level breakdown on both this document and this classification framework as well. But really, really interesting. Category 3, digital tools. Crypto assets. So we went through digital commodities. We went through digital collectibles. Now, number 3 here is digital tools. So crypto assets that perform a practical function are what they are deeming as digital tools. So membership tokens, event ticketing or tickets, credentials, identity badges, soul-bound tokens, anything that essentially represents verifiable work, history, or professional certifications. Think of a museum membership. You don't buy it expecting to profit from the museum's management team. Same logic applies. These are not considered as securities. Digital tools. Category 4 is stablecoins. This one is obviously the most straightforward here because Congress already acted. The Genius Act passed in July of 2025 and created a comprehensive framework for payment stablecoins and explicitly excluded them from the definition of a security. The SEC is just aligning here. Payment stablecoins issued by permitted issuers, such as banks, subsidiaries, federally or state qualified issuers, are not securities by operation of statute. One condition the document highlights is that permitted payment stablecoin issuers cannot pay interest or yield to the holders. No yield means no securities classification. That is the line. That's an interesting line, but that's the line. I know I've seen a lot of kind of back and forth about stablecoin yield. Category 5. Now, this is digital securities. Now, look, I know that there's a lot of assets outside of Hbar, Solana, XRP, Algorand, AVAX, Cardano, Link, anything else that was in that initial listing. There's a lot of assets that certainly meet the definition and criteria of digital commodity. They're just not in the document. So, and look, I get it. At the end of the day, I think that this is a lot better than what we've had before. I would imagine that this probably isn't the end of what we see. There's probably going to, if I had to guess, be some sort of a meeting the criteria type thing. And maybe we'll get into that here in a second as well. But category 5, digital securities. So these are financial instruments, stocks, bonds, notes, investment contracts that happen to be formatted as crypto assets. So we're talking about tokenized treasuries, tokenized equity, so ownership in an actual company, tokenized funds. These are securities. They were always securities. Putting them on a blockchain does not change what they are. And this is the key point. The SEC's enforcement jurisdiction under this new regulatory framework applies, or I should say regulatory guidance, interpretive final ruling, applies primarily to this last category. This is the SEC's wheelhouse. And finally, we have clarification into what that wheelhouse actually is. The SEC is doing what it always essentially does, but at least we have some guidance on what that should be. The 4 categories before it, digital commodities, digital collectibles, digital tooling or tools, and digital stablecoins or stablecoins, are not the SEC's domain. This is a seismic reduction in the SEC's footprint historically in the crypto industry. Like literally, this is a polar shift. Now, I'm not going to talk too much about price today just because I feel like a deep dive into these documents are well enough justified, and price fluctuates daily. So really at the end of the day, I could care less. But I will say I've been mentioning for the past month that I started essentially buying crypto again. I didn't buy the bottom. I think if that was the bottom when we had that capitulation candle early in February or whenever that was, I didn't buy there, but it was real close when I started being like, okay, this is too much fear, blah, blah, blah. But I started feeling again, like over this past week, I know I mentioned, I'll pull it up real quick for 1 second. I know I mentioned that I essentially was buying until the 21 EMA crossed back above, or until price action got back above the 21 EMA. I actually canceled my automatic buy orders as of like late last week because I have them like normally set up for the 1st and 15th just because it's easier that way. I canceled them just because stuff was getting too positive. We saw a big drop today. That is not surprising to me at all. I think especially right now when emotions are so high and when we got like literally the biggest piece of crypto industry news in the history of crypto yesterday, of course, the big money and big whales are going to trade right on top of that. Your emotions are like literally a playground to people that have more money than you, more money than me, more money than all of us probably combined that are watching this video. Anyways, back into this. What I will say is now, given that maybe I'll do a video tomorrow or something about where I think we're, like I've said this before. I think we're going to chop around here in accumulation zone for a while. Maybe we're wrong. It does feel like I've said before that something is off about this cycle. This past 12 to 18 months it seems off with so much adoption that we're kind of where we're at. But hey, I've said this before, like until something is different with the 4-year thing, or until something is different with historically what happens versus what's happening now, it's not different. So I don't see any reason to really play it any differently. And in that regard, it's like, okay, if we chop around an accumulation and prices kind of waddle back and forth here, I'm not going to buy on a massive, or I'm not going to try to buy during a massive weekly candle. I actually saw here on the daily. Now, the daily is going to give you a quicker picture of kind of what's going on, but then you want to like zoom out really to kind of get the macro view. So were we around any sort of support or resistance? You probably have to mess around with the moving averages if you really want to get into that. But anyways, here we are on the weekly and the monthly. I care more about the monthly, but looking at the weekly right now. Anyways, let me go back because I am not a chart guy. Yes, but I mentioned this is a seismic reduction in the SEC's footprint in this industry. And it's written into this final rule. So essentially, we have, as I mentioned, digital commodities, digital collectibles, digital tooling. We have stable coins, and we have then digital securities, which essentially are securities that just happen to be on blockchain, which that's the SEC's domain, and everything else is not. So let's talk about the list of projects here and what this means. So we'll go do a quick search. So digital commodities. Now, if you were on, X or whatever yesterday, this post almost has 1,000 likes, and we were even a couple hours. I was like an hour late to even realizing what was going on because I had just filmed that video that I posted to you guys yesterday. And I was trying to make chicken chili for my kids because my daughter had a chorus recital or chorus thing, orchestra thing that I wanted to go to. So I was like trying to get all this stuff out real quick. Anyways, let's talk about this list that just came out, because the SEC didn't just define categories in abstract. They named names, as I mentioned, 16 assets explicitly classified as digital commodities in release 33 Tech 11412. You can go look for this yourself. But I'm going to go through every single one of them because each of these really does carry real weight. So Bitcoin, the original, already treated as a commodity by most of the financial system, but now officially recognized under this joint ruling from the CFTC and the SEC. Ethereum, the transition to proof of stake, years of debate. So this was kind of the big question around Ethereum. Does proof of stake shake up the apple cart here? And years of debate over whether staking made Ethereum a security or not. But that debate is now settled. Ethereum, and I know there's a lot of drama around Ethereum, but Ethereum is a digital commodity. Solana, Sol, explicitly named in SEC enforcement actions against exchanges, but that flag is now gone. The fastest growing retail layer 1 in crypto just got cleared. It is a digital commodity. XRP, so 4 years of Ripple litigation. We finally got clarity, but hundreds of millions in legal fees. The SEC claimed that XRP was a security. We see a lot of rug pulls and scams and stuff in crypto, but I don't see or seem to remember a situation where we have the ability to fight back whenever, ecosystems that we've been shouting from the mountaintops for years, like do not represent a security, get hurt because of regulatory, not even gray area, but regulatory like black cloud. Like we don't have the ability to fight back. But anyways, Ripple, as we know, paid hundreds of millions in legal fees, took it on the chin for the entire industry, whether, people want to admit that or not. Ripple did do it. Ripple said commodity. We all say commodity. So this rule says commodity. XRP. This is just further verification that XRP is a commodity. Hbar, built for enterprise from day one and has obviously, I think decentralized is an understatement, because literally the code base of the code base of the Hedera network is literally governed, or it's governed by, all these entities. But essentially you have LF Decentralized Trust. The Linux Foundation essentially manages the code base. So, I think, you talk about enterprise adoption, but, I think it's pretty massive for Hbar here, but conservative, very conservative as far as how a lot of the rollout for the Hedera ecosystem has been. Very compliance-focused architecture. I know that the community has been screaming for years, and I don't know if this happens or not, for being able to operate their own nodes on the network, not a mere node, but like a node on the network. Who knows if that happens or not, or where that's going. But at the end of the day, this is gigantic for the whole Hedera ecosystem. You guys know how long I've been covering Hedera, even outside of the Genfinity stuff. Obviously, do your own due diligence. We have a media relationship within Hedera, but I've been covering Hedera way before that, and Hbar way before that. It was certainly not popular to do Hbar and Hedera interviews back in 2020 and 2021 when nobody knew what it was. But it's awesome to finally see. And we've had a lot of clarification around a lot of growth from that ecosystem as well. But now this strategy that has been taken, and the decentralization of the network and what has went on and how everything is operating at this point in time, that's all validated under federal law and this final ruling. One that's not mentioned in the main paragraph, but in the footnote, and again, due diligence, Genfinity has a media relationship within the Algorand ecosystem. But specifically, this document names Algorand and library credits as additional examples beyond the main list, confirming the framework applies broadly beyond this. Again, as I mentioned before, this confirms that this framework applies much further beyond what is even mentioned here. So you have kind of these assets here, then you have the footnotes down here that mentions Algorand and library credits, and it's just obviously this is guidance for the entire industry. They can't mention the entire industry. Avalanche is absolutely massive. I mean, I don't cover Avalanche probably enough. I'm one person, so it's difficult. But I know from an RWA standpoint, I think I probably still hold AVAX back in the day. But we know subnets architecture. We know RWA focus. We know institutional focus. Roots in New York. So what's interesting here is we do have a lot of entities that have roots in the United States. ADA and Cardano, so Wyoming-based, but years of academic peer-reviewed development, also a digital commodity. Link or Chainlink, the Oracle network that's powering like literally almost every layer one and every network. So you're talking about not only Oracle's, but interoperability. You're talking about not only Oracle's interoperability, but kind of an on-chain runtime environment. You're talking about all sorts of stuff that Chainlink offers. And for anybody that downplays what Chainlink has accomplished, they aren't looking or are willingly being ignorant to the fact that Chainlink is being massively adopted by industry giants such as DTCC, so Depository Trust and Clearing Corporation, or Swift, or Canton, or any of these other entities. Ripple, I know, uses Chainlink. Hedera uses Chainlink. They all use Chainlink. So DeFi, RWA infrastructure, and cross-chain data. It's very apparent that Chainlink is pretty fundamental when we talk about institutional on-chain finance, or I think as Solana likes to put it, internet capital markets, digital commodity, Chainlink, Link. Dot and Polkadot. So we talk about parachain ecosystems. This is essentially what I believe, and I could be mistaken here, but I remember with Flare and Songbird, they kind of took a note from a few different entities out there, one of which being Polkadot and the parachain kind of hierarchy. So Polkadot, obviously cross-chain interoperability at the protocol level, digital commodity. Litecoin, digital commodity. XLM, Stellar. So, you talk about Franklin Templeton and CBDC pilots and cross-border payment infrastructure, digital commodity. Tezos, digital commodity. Aptos, digital commodity. Dogecoin, digital commodity. Shiba Inu, digital commodity. Bitcoin Cash, digital commodity. Solana, again, San Francisco. Ripple, San Francisco. Chainlink, American founders. Litecoin, Charlie Lee, American. Avalanche, New York. Aptos, Palo Alto. Cardano's IOG, Wyoming. Hedera, Texas. Stellar, San Francisco. Do you get the trend, right? 9 of the 16 assets have direct American roots. There's probably more than Algorand, I believe, is also American, right? I think Boston. So, yeah, not offshore projects trying to access U.S. markets. These are like American companies that I think Algorand just moved back to the United States is another example. So we are Solana just announced, I think it was last week, super team. So like they're kind of the ecosystem cultivation arm for developer onboarding, for builder help and outreach, and I'm sure all sorts of other things. I saw posts that were saying that like people didn't think that they would ever have that type of an arm in the United States. And here we are. They just announced it last week. So like we are literally seeing kind of a reverse exodus back onshore into the USA. I will say from a personal standpoint, outside of even doing this video or trying to compile this video, what I'm looking forward to is I know for a fact that like a lot of these layer ones have historically just not been able to be bullish about the assets. Like it would be pretty badass for, in my opinion, to have, and I don't know, I don't know if this happens or not, but like to have like Hedera bull posting hashtag Hbar posts, like that would be cool to see, right? I mean, Ripple, I think actually for those of us that have been here since the beginning, Ripple was not bull posting about XRP they literally couldn't during what was going on with the SEC stuff. So like, I don't know, for me, like I think we all believe in these ecosystems. I think we all believe in these ecosystems as kind of these almost at this point in time, these almost like self-sovereign entities to an extent. I mean, people were building whether entities are here or not. I think that they're fairly decentralized at this point. And that's only, continuing. And I think that the writing's on the wall there. So you could make arguments all day about how decentralized something is. But at the end of the day, we've even seen the highly enterprise focused layer ones end up kind of going like the decentralization route over time. And that's only going to continue. So like for me personally, like I would love to see Ripple talking, referring directly about XRP more. And we've literally seen that over the past, 6 to 9 months, actually since kind of the regime change in Washington. We've seen a little bit more of the inner workings of some of these entities. And I'm hoping that we see more and more of that, because at the end of the day, I would love to see that level of, like, on this channel, and I'm sure on a lot of YouTube channels and stuff, we get like, I don't know. I try to like, I'm like legitimately excited sometimes when I talk about some of this stuff because I truthfully believe that this is like the future. So like, I want to see that same thing from like the big entities, and I think that they just haven't been able to do it. So I'm excited that I think that they'll be able to show us that they're excited, like if that makes any sense. But anyways, these are American companies built by American founders, spending years operating under the legal threat in their own country. Previous administration called crypto asset securities sued the founders of crypto, of a lot of these networks. And the current administration just named them commodities and cleared them. So this is like totally a polar shift of policy reversal. So another big thing here is staking, mining, airdrops, wrapped assets. So beyond the taxonomy and the named assets, and again, you can go to genfinity.io and check out the classification framework. Beyond the taxonomy and the named assets, this document, which is this 331111412, it makes 4 additional rulings that the industry has needed for years. And I'll go up here to the table of content so that you guys kind of see it. So you can even see here, you know, how crypto assets become subject to an investment contract, mining, staking, all of these different things here. So if you're in the document, nice, they have like the actual hyperlinks that work right within the document. So you can go and check it out. Maybe I'll drop this in here too, or I'll just drop this, both these articles in here so you guys can search through. But 4 additional rulings that the industry has needed for years, as I've mentioned, each one clearing a specific activity that's been operating in legal gray space, or let's say just the black cloud. Number 1, protocol mining. So proof of work mining, including Bitcoin mining and mining pools, is not a securities transaction, full stop. The document is precise about why miners are performing an administrative or ministerial function. They contribute computational resources to validate transactions, and they receive rewards from the protocol in exchange for that work. That reward is payment for a service rendered to the network. It is not profit derived from the essential managerial efforts of others. No Howey test issue, no registration required. Mining pools are also clear. Even when a pool operator coordinates resources, maintains hardware, manages security, and distributes rewards, those activities are administrative and ministerial per this document. The miners themselves are not passively relying on the pool operator's management for their returns. They are contributing computational work. The operator is facilitating that work, not generating profits on their behalf. Now, I think the big one here that a lot of people are kind of interested in is protocol staking. So this is bigger for the current ecosystem, and there's 4 forms of staking that are essentially addressed here. You can go and find this within this document as well. All 4 of these forms of staking are cleared. Self-staking is number 1. So a node operator locks up their own assets, validates transactions, and earns rewards. Based on this document, that is not a securities transaction. The rewards come from the protocol, not from any third party's management effort. Self-custodial staking with a third party. So you delegate your validation rights to a node operator. The node operator's role is administrative. They are running the hardware. They are processing the validation. They are then distributing the rewards to you. That is not essential managerial effort, and they are not considering that a securities transaction either. Custodial staking. A platform holds your assets and stakes on your behalf. As long as that platform is not making discretionary decisions about whether, when, or how much to stake, they're not guaranteeing returns, and they're not using their own assets for operational purposes, for their own operational purposes, custody and staking are not considered security offerings. So not a registration requirement. And the last one here is liquid staking. So liquid staking is where you deposit assets, the native asset, let's say, and you receive almost like a staking receipt token that represents your position. Essentially, when you think about this, is it allows you to lock up your assets, potentially earn yield, And you essentially still maintain the ability to do things with your assets, because historically in crypto, you basically lock an asset and you stake it and it's locked. You then basically don't have a liquid asset, for lack of a better phrasing. You have, you're getting, staking yield or whatever you're earning on locking that asset up. Liquid staking is essentially saying, hey, you can lock that asset up. Here's essentially an IOU that you can still use out there in the ecosystem. You still have liquidity, blah, blah, blah. Anyways, but liquid staking, that token is a receipt. It evidences ownership of the deposited asset. They're not considering liquid staking as a security either. The liquid staking provider's role in selecting a node operator, that's their only decision in the process. And the SEC, CFTC joint ruling here states that is administrative and that is cleared. All of these conditions that have kept staking outside of securities law are now clear. Don't make discretionary decisions over users' assets. Don't guarantee returns. Don't use customers or consumers' assets for your own business. If you stay inside as an entity or as a provider, whatever it may be, or node operator, then you're taking other people's stake, within inside your validator, whatever it is. If you stay within those conditions and you are operating in clean regulatory space, well, then you are operating in clean regulatory space. So like literally it's pretty cut and dry, which I think is pretty interesting. There's like, it basically is like saying you can pretty much do what you want. Just don't guarantee returns. Don't do stuff with customers' assets, blah, blah, blah. So the big one here also is airdrops. I mean, I remember how taboo it was for a while. Like airdrops were huge at the beginning. I think like 2020, 2021 timeframe, the airdrops were absolutely massive. And then they like really disappeared just because of the lack of clarity. When an issuer distributes a non-security crypto asset to recipients who do not provide money, goods, services, or other consideration in exchange, that is not considered a securities transaction. Why? So because the first element of the Howey test, an investment of money, is not present. You cannot have an investment contract without an investment. This clears the standard retroactive airdrop model used during the protocol testing period. The issuer announces after the fact that those users would receive tokens. There's no consideration exchange for the airdrop, so it's not a securities distribution. And then finally, number 4, wrapping. So cross-chain bridges, wrapped asset providers, the process of depositing a crypto asset and receiving a wrapped version of that asset for use on a different network. So we're talking more about interoperability, not even interoperability so much, because that's not really interoperability, more about being able to bridge onto different networks and do other things. The document is explicit, wrapping a non-security crypto asset one for one with no yield, no discretionary management, locked and not rehypothecated. That is not a securities transaction either. The wrap token is a receipt for the underlying asset, similar to how a liquid staking token is a receipt for a native asset. And the wrap token's value derives only from that underlying asset, not from the efforts of any third party. Again, it's an administrative function and not a security. So wrapped Hbar, wrapped Sol, wrapped ETH, cross-chain bridges facilitating interoperability between networks. All of it has just been cleared. This is a lot to get through, guys. So again, I mentioned at the beginning here, obviously there is a process on maybe crypto assets that are subject to an initial investment contract. So then what is the process for a token to clear itself and become a digital commodity, or maybe some sort of digital tooling, or whatever it may be? So this is the section that a lot of people are going to miss. And it's obviously a very important one of the more important ones in this document, because different networks and different protocols and different tokens and everything happens at a different time in this space. Every project that launches is a little bit different. All the ownership and management efforts are different across every single network, project, protocol, platform, whatever launches in this space. Everybody does it different. So if something launches and represents an investment contract at first, the SEC established a complete life cycle theory for how assets move in and out of securities transactions. All right, and here's how it works. A non-security crypto asset, so a digital commodity right now, or a digital tool, or a digital collectible, can become subject to an investment contract if the issuer offers it in a way that induces buyers to invest money in a common enterprise based on explicit representations or promises that the issuer will undertake essential managerial efforts from which buyers will profit. In plain terms, somebody launches a token and they make specific promises about what their team is going to build, and then the investors buy because they believe in those promises, and the combination of that investment plus that promise creates or equals an investment contract. That token would now be subject to securities law. The offering would have had to have been registered or conducted under an exemption. That is not new. So this isn't like some new scary thing. This is literally the Howey test applied to crypto. Here is what is new. The SEC explicitly states that investment contracts are not permanent. A non-security crypto asset ceases to be subject to an investment contract when either the issuer A, fulfills its representations or promises. So when the work is done, the roadmap is delivered, the network is functional, or the network is decentralized enough, or when the issuer is clearly and publicly abandoned. Hey, it didn't work out. Abandon the project, and those promises can no longer reasonably be expected. So when the issuer has fulfilled what they initially promised, the investment contract ceases to exist. Subsequent sales of that asset are no longer securities transactions, and the SEC's jurisdiction, as per this ruling and interpretive guidance, would end. Think about what that means for every early stage project in this industry. So you may launch and you may be building under, a lot of projects obviously do capital raises at the beginning, and they're like, hey, this is what we're building. Obviously you could read deeper into this. I'm certainly not, saying from the SEC or CFTC standpoint. I'm trying to break this down for you guys. But if I was a project launching, I would be very cognizant of what I'm putting out there as far as what I'm building. And I'll be very cognizant of when some sort of a capital raise or whatever happens during that time phrase, aka the launch of a token. So you actually have guidance now. You better be, do whatever you want. But if I was launching a token, I would be using guidance for sure, because I would want to make sure that I'm setting myself up for success, right? And setting everybody else up for success. But anyways, you can build under a securities framework. You can register your offering or use available exemptions. You can be transparent about your roadmaps. You can deliver upon your milestones. You can achieve decentralization. And when you've done all the work that you promised, your token can no longer be qualified as a security. It graduates. It becomes a commodity. This is something that we really haven't had in the regulatory gray area either. So even though, yes, we should be cultivating startups in the United States, and yes, there needs to be investor protection, and yes, there needs to be liability and upholding of that liability for projects that launch and do capital raises and promise all sorts of stuff. This is, like, to me, a good thing, obviously, because at the end of the day, and who knows, maybe I'm wrong here, we want to have that level of accountability for projects that launch in this space and that leverage the technology for real business models. But we also want to be able to cultivate innovation. I think that reading through this, at least in a bird's eye view from my stance, when I look at like digital tooling, or when I look at collectibles, or when I look at digital commodities, I look at digital commodities almost in a way where it's like, okay, well, this really is like the ability to launch like a real world business model and have other people participate in it. And maybe if I do it in example A way, maybe it does represent an investment contract at first, but I can build right into my like roadmap what that potentially looks like and be like, okay, well, I need this capital raise because of X, Y, and Z reasons. And maybe it does look like an investment contract at first, but at what point, have I fulfilled my deliverables? What bootstrapping do I potentially need? Like, I think it puts a lot of power in the hands of individual projects, individual startups to be able to say, hey, I'm building this in. Yes, I understand what this is at first, but I know how to prepare now. I know how to launch. I know how to build. I know how to do it compliantly in the United States. And if I'm just launching collectibles, I'm just launching collectibles. I don't have to worry about it. I mean, based on what I'm reading here, or if I'm just building tooling, I'm just building tooling. Like, there's all sorts of really interesting things that I think are going to spin off of the back end of this. And I think that, I don't know, I just look at this and I say, again, this is a video that I think I've been waiting to make for like years in this space. So Chairman Atkins previewed exactly this pathway with forthcoming safe harbor rules as well. And I know they mentioned cultivating innovation in the United States. So startups under $5 million that are exploring crypto in their first 4 years, that can raise, or that raises up to 75 million via investment contracts involving certain crypto assets. So these are safe harbor rules, and I definitely recommend you guys look more into some of the stuff that Chairman Atkins has previewed here. So raises up to 75 million via investment contracts involving certain crypto assets, decentralized projects that achieve the exit conditions cleanly, startups under $5 million exploring crypto in their first 4 years. That looks like there's going to be some safe harbor activities here. But the SEC is building an on-ramp and off-ramp. You should be able to launch a project, and maybe you launch a project that starts as a security, but you do the work. As I mentioned, you reach decentralization, you emerge on the other side as a commodity with CFTC jurisdiction and full secondary market liquidity, which is like, okay, I mean, you kind of graduate, but your liabilities are fulfilled, and now you essentially have this kind of self-perpetuating ecosystem or community or token or whatever it may be. So none of that ever existed before. But it does exist now, and I think it's pretty crazy. So anyways, what this all unlocks, because this is, I'm trying to ramp this down. I know this is a really long video for you guys, but real world consequences of this document, what actually changes. First, institutional capital flows. So banks, pension systems, sovereign wealth funds, asset managers, these are entities that have had crypto on their radar literally for years, but couldn't move or couldn't touch it because their compliance and legal teams could literally not get a straight answer on regulatory status. And that answer, as I mentioned, now exists. It's in writing. It's a federal final rule signed by both the CFTC and the SEC. The 16 named assets represent the vast majority of institutional interest in crypto. Looks like that as far as right now is concerned. Bitcoin and Ethereum but obviously outside of those 17 assets, there's widespread implications here. There's tons of assets in crypto, right? This is, I think, probably what they could just fit within within the document. But Bitcoin and Ethereum, let me just do last sip of water, because this is like probably the longest video I've ever done. Bitcoin and Ethereum were largely understood already. I guess we could argue staking with Ethereum, but when you think about like Solana, Hedera, or Hbar, literally I should just start saying the assets. So Sol, Hbar, Link, ADA, AVAX, DOT, XRP, these all now have the same formal clarity. So every fund manager, every trading desk, every custody, and I guess I should say, for all the other assets out there, there is clear-cut guidance as well. So you could argue they have formal clarity just as much so. Every fund manager, every trading desk, every custody provider that was waiting for permission, the permission is literally here. Capital flows where rules are clear, and the rules are pretty clear now. This is essentially like a Market Clarity Act without a Market Clarity Act. Second, exchange liability is dramatically reduced. The existential question of whether a token listing triggers securities registration requirements has been one of the primary reasons United States exchanges have been conservative about adding certain assets. For the assets that we just named and assets with similar characteristics, that question has now been answered. So we talk about level playing field in crypto and what crypto is going to do to democratize access into systems for like the world's citizens. The crypto hasn't had a level playing field even within its own walls. And if you don't believe that, ask any protocol or layer one builder that's tried to get listed on an exchange. Now it's kind of like, okay, well, the excuses go out the window. The SEC has literally told us now that these are commodities, digital commodities. So list them, clear them. Let's start building markets around these digital assets and real world business use cases, not just these speculative ones that every asset still today, 99.9% of crypto is still pure speculation. You want to wonder why announcements don't move the needle for price action. Well, it's because like, yeah, there's a ton of announcement recently, but there isn't a whole lot of use outside of speculation. This should open the floodgates around crypto for real world use cases. The real world asset tokenization layer that we have been talking about on this channel for a while, the trillions that are coming, now has a legal foundation. This needed to happen for the trillions and trillions and ultimately quadrillions that we know are going to kind of run over top of blockchain rails to essentially function. Digital securities are explicitly defined in this document. Tokenized treasuries, tokenized equity, tokenized fund interest, tokenized bonds, all of it falls cleanly into the digital securities category. These instruments are securities. They've always been securities. They're treated as securities now, and they have a clear registration path and clear regulatory framework. Oh my, this is a long video, but this is essentially what institutional RWA infrastructure has needed. Not ambiguity, certainly, not gray zones or, innovation black clouds, but clear categories with clear rules. This is like DTCC, Broadridge, Franklin Templeton, that BlackRock, institutions building real on-chain settlement for on-chain settlement infrastructure, internet capital markets, all that stuff. They now have the regulatory foundation to build. And finally, staking products are a legitimate business. So liquid staking protocols that have been operating in kind of a regulatory gray space or black cloud, the risk is now resolved. The turf war between the SEC and the CFTC for now seems to be over. I think that this is just an absolutely ridiculous kind of story here for this industry. I know we went over a lot today, but this source documentation is all kind of here as well. If you guys learned anything from this video, this is the kind of clarity. Take one thing away. This is the kind of clarity that the crypto industry has needed for a decade and a half. And the more people who understand what just happened, the doubters out there when you go to Thanksgiving dinner or Christmas with your family and they're like, hey, how's your crypto going? Well, you can tell them now that crypto essentially, the United States financial regulators have come together to create a clear path for cryptocurrency adoption in the United States. So they better watch out, is how I would basically say, all that stuff you've been laughing at every couple of years when prices go down for crypto and everybody, laughs at you and everything else. They're not going to be laughing when their retirement accounts are like all based in like crypto, when all of the stocks that they hold and the commodities and the everything else is all tokenized versions of it. You better believe, just like people that made fun of, I'm sure, people that were early whenever all the internet stuff started, how's that internet going and how's blah 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 going, they're all using their phones daily. They're all doing what people do. They're all doing, and it's like, look, it takes a lot of guts to responsibly take risks in life and kind of be a contrarian for your beliefs and what you see and what is coming, and doing the actual research. And even like these videos, do your own research. I mean, that's super cliche, but at the end of the day, like, don't believe anything I say. Go and read all this stuff for yourself. Figure out where you think the markets are going to go. Figure out what assets, because I know yesterday there was a guy that was like, did you miss say an Aptos or not on your radar? And I'm like, not really. I'm like, I'm busy. Like literally I wake up and by the time I go to bed, I look at crypto stuff. I do crypto interviews. So yeah, not on my radar. Like I actually, and then I'm like, I look back and I'm like, oh shit. Like I tried actually getting in every interview with Say, and I'm kind of still waiting for them to get back to me. And Aptos, I mentioned here and there, I mentioned them today. It's like, but I'm not like waiting. I'm not like reading other people's research. Like I'm doing my own thing. Like everybody else should be doing their own thing. You have the ability, like people have the ability to make their own decisions and do everything else that they want to do. I feel like this space is such like a hand-holding. A life is such a hand-holding thing. And it's like, quit waiting for somebody to hold your hand and start, taking steps forward on your own. I'll repeat what I said before. I think that we're in a really interesting spot with where crypto is. And I look at, if this doesn't tell you where global markets are going, outside of all the news and stuff. And like, people were like, well, it's complaining, being like, this has no effect on anything. Yeah, but this just another announcement that's pointless. And it's like, okay, dude, like, go out and get some sun. At the end of the day, you can either have that mindset, or you can literally look and realize that all markets are coming on chain. The entire world's financial systems will be operating on blockchain and DLT. A lot of them probably already are using DLT in some way, shape, or form under the hood. And you look at like the price action right now for what's going on. I mean, it's such a small way of thinking about things, just to be so negative. It's like, dude, this is like the biggest opportunity. And I know it's again, a cliche thing to say, but like every few years, and hey, if it keeps happening every few years, I will keep saying it. It's the biggest opportunity that, like, obviously not financial advice, that I think we'll ever have. And at some point I've got to believe that, like, just like what happened with, I mean, hopefully we don't have to wait, what is it, 50 or 60 years, like what happened with silver. But at some point, I mean, the bow has to break, right? Like, there's enough writing on the wall. The traditional system, I think we all know, is fairly broken at this point in time. They have to shift it on chain. They just have to do it. And they're probably going to, it seems now like they're pivoting from, like, stable coins is certainly an option, but I think it might be more likely that the easier selling point here that people can digest is like tokenized deposits, because you really don't have to explain anything or do anything different from a clarity standpoint. It's basically just like, everything's already has a green light. And now with this documentation, like, pretty much crypto has a green light. Anyways, you can go read the articles, genfinity.io. There's two of them. There's one on this interpretive guidance, this release right here. And then you can read about all the assets here. You can go to the release here, sec.gov, the interpretive rules, full things in here. The fact sheet is here. Again, I mean, I've said this before. I just look at this space as an opportunity. A sidebar, I published an interview today. I published 3 interviews today. So I did an interview with PricewaterhouseCoopers, and a lot of this stuff, again, is just like so under the radar. The Hashgraph Group, or Hashgraph Association, has a relationship with PwC, right? So this is coming out of the Hedera ecosystem. And the Hashgraph Group has, like, kind of this Hashgraph for enterprise, these different products, right? There is global regulation for digital product passports in the EU that I think goes live next year in 2027. And the product out of the Hashgraph Group is called Track Trace. So essentially, you think about like life cycle management, essentially, of like different products, right? And he mentions like one in particular use case is like cacao. So like chocolate, for lack of better phrasing, from basically farm to manufacturer, and then manufacturer to, our house, or grocery store, and grocery store to our house. So like the full life cycle. Really fascinating interview. And I think it just paints a picture that there's global legislation that might not on the surface have anything that appears to do with crypto, DLT, and blockchain. But the only way they're going to actually facilitate meeting this regulation is by blockchain and DLT. Or I guess maybe not, I shouldn't say the only way. The way that seems to make the most sense would be through blockchain and DLT. So you can obviously think about the transparency that happens when you use blockchain and distributed ledger. You can think about the ability to essentially really have an open framework for trust, for being able to like do audits on certain things. There's a lot of use case for supply chain and blockchain, but we are still kind of at the mercy of kind of global legislation. Like even digital documentation is another example that would fall into kind of that type of legislation. But yeah, this was a really good interview. It's not super long, but Hussein talks about now he's PwC Deutschland, so he's the head of blockchain at PwC Deutschland. So digital product passport, trade finance, and global tokenization. I did another interview This is Devin Morthy. This is Algorand Foundation supports these interviews out of Genfinity. So Devin Morthy, ex Ripple, now leading business development partnerships at Algorand Foundation, and Ben Milne, I think is his last name, of Braille. Really fascinating interview if you're interested in stablecoins. So Algorand just did an integration with Braille. This is like maybe January-ish, I want to say. Braille has kind of widespread stablecoin infrastructure, and essentially, you have a network that already can do atomic settlements, where a lot, the vast majority of things on Algorand happen natively on chain that had with no downtime, essentially. Really good for payments. And then you essentially think of what happens. Like Braille has basically taken what you would have had to have essentially, invested in the infrastructure of like a PayPal or one of these gigantic behemoth payment companies to be able to, launch regulated kind of stablecoin or payments infrastructure globally. Braille has essentially taken what would have taken millions of dollars to do, and they're across multiple different networks. I mean, you can go to Braille's site; they have tentacles in tons of networks. So you can see all the networks here. They're on Hedera, they're on Algorand. I think that's Polkadot, Avalanche, Solana, Stellar. I'm not XRP, so you're not going to be able to get them all. So, anyways, essentially, like I said, I mean, you can take literally, you can like deploy a stablecoin in less than like a regulatory compliant stablecoin in less than 30 minutes. And it's just like, wow, like how far we've come. I like really zoomed in there. How far we've come since just even a handful of years ago. Just with stablecoins. And I mean, we didn't even get into like tokenized deposits in this chat. So this is a fascinating interview as well. So PwC, Braille, and then this one is really interesting too. So this is out of the XDC ecosystem and supported by XDC Foundation. So make sure you guys are doing your own due diligence. But this is out of Genfinity too. And this to me is maybe one of the more fascinating interviews, because essentially what you have here is an individual that's been in metals mining and critical minerals mining for 30 plus years. I think, and you fact check it if you guys want, but so you can look up, it's Lionheart, Lionhart Capital. But essentially you have a guy that has like the largest titanium mining operation in Africa, tons of different kind of like mining operations, mostly throughout Africa and stuff. And I know when we talk about tokenization of real world assets, we talk about the low hanging fruit of like bringing the real world assets on chain, which is like great. But this is like a totally different kind of spin on things, where it's like not even the tokenization of the actual precious metals or the minerals, but the actual financing to allow that mining to occur in the first place is being tokenized, which is like, I've never heard that use case before. I thought it was really interesting. This was a really good interview. And this is a guy that understands blockchain, crypto, DLT, and how to use it in like a real world business practice, because this is what this guy does is real world business. He's been doing mining of critical minerals and metals for like 30 plus years. So these are the types of interviews that I get really kind of interested about, regardless of like the media relationship with XDC Foundation and Genfinity or not. Because these are the type of interviews where you get to hear from people that have built extremely successful real world businesses that are now looking to leverage blockchain, distributed ledger, and crypto technology for ways that can make either A, make real money, or B, finance real operations, or C, save money, whatever it may be. So those are the three interviews that I just published. I'll be publishing a Drifts protocol interview tomorrow. That's out of the Solana ecosystem. Next week, the track trace thing that I talked about from PwC, I'm doing an interview there. That'll be a Hedera ecosystem interview. I'm trying to think of anything else. But anyways, you can give at Genfinity a follow on X or on YouTube at Genfinity Media, or go to genfinity.io and you can check that out. But long story short here, this is the dawn. I know it's like super cheesy and cliche to say, but this really is the dawn of kind of the digital assets era. What we are watching, and I think Carmel Cadet said this probably best, is the kind of the birth of a new financial system, the convergence of the traditional and kind of the digital. These lights are really bright behind me. So anyways, this was the longest video I've ever done. I hope you guys enjoyed it. I hope that was a decent enough breakdown. And yeah, I'll talk to you guys when I talk to you. Thanks. Bye.